Hey, what's happening, guys? Dan Darrow here with another Options in Play video update. Hope everybody had a fantastic weekend. We have started this week already with a bang. Volatility, which looked like it may have started to recede following the election, is all of a sudden creeping back up again. So, could have a pretty interesting week in store for us, especially with the way that we've started here. Um, In the context of that, what I want to talk about today is implied volatility and how it relates to event trading and also individual setups. So in this case, AMRN. Uh, so whether or not you're familiar with it, implied volatility, or whether you love it or hate it, the truth is that implied volatility really plays a huge role in options trading. It's the undeniable fact. Uh, I, I'm not going to go into the like the mathematical derivation of how you get to implied volatility, or like we're not going to like calculate implied volatility. Um, maybe some other day. I mean, could spend like hours doing that. But what you need to know is, long story short, implied volatility essentially means the magnitude of the expected range of a stock. So in this case, AMRN over that specific contract's lifetime. So each contract will have a different implied volatility. And what you tend to see is that options that are closer to expiration will have higher implied volatility versus options that are further from expiration. So like longer dated contracts will have lower implied volatility. I mean, there's differences and there's exceptions to that rule, but kind of like generally summing it up, like that's implied volatility in a nutshell. And if you're wondering why I'm bringing it up now, it's because Ameren over the weekend, and actually this morning, is providing a pretty useful lesson just implied volatility and kind of how it impacts events and just options trading. So I wanted to spend the video like talking about it a little bit. So for those of you not familiar with Amarin, this is a drug or well, they currently have a drug on the market, and they released just really incredible drug results at the end of September, which we had a trade on, and the stock just has been an absolute monster. Just 1,000%, well, not 1,000%, but 800% gainer, basically since the end of September. So going into this weekend, the company was scheduled to present the full data set from this trial, a phase 3 trial that sent the stock just like tearing higher. So to say expectations were high is a serious understatement. And everybody in biotech or pharma watching this, because the drug results are really quote unquote groundbreaking. I mean, you've seen that thrown around a lot with it. So everybody was watching it. Traders were watching it. So not only did you have like a ton of eyeballs on the actual presentation, but the stock was pricing in a massive move. So 7.5 points was what the straddle expiring this week was pricing in. So for like a $20 stock, 7.5 points is about 35%. And that meant that the implied volatility of near-term contracts was astronomical. It went out over 300% implied volatility. And for some people, they might not really be familiar with what that means, but that's like a staggeringly high implied volatility. And I mean, you could also kind of see it with the price to move, right? I mean, it's a 35% move in a stock in a week's time frame. So it just shows that the expectations for a huge move were exceptionally high going into this. And what happened was, the presentation was good, but as often happens with things like this, which are, the longer you do it, like the more you'll come to realize that there's a lot of nitpicking and people are trying to poke holes in data. It's just the nature of how it works, and So like the kind of like the mixed commentary is like deflated it a little bit, you know. So it's not really getting hit. Obviously, it's not up. I mean, it never really traded up today. It was up in the pre-market, but once it opens, it's been trading lower. And I mean, it's not getting hit because the data really is pretty remarkable. But it's down a couple bucks, and what you're seeing is that the options that were pricing in 7.5 points right now, you could probably buy that same straddle for like 275. So lost about 60. So say about 2/3 of its value, give or take. You know, so and it's just one of these really maybe not like under the radar, but less like focused on risks when it comes to events. You know, people kind of just have their opinion of what they want with the stock. So in this case, there's been a lot of bullishness on this, and you know people were expecting another leg up to like the to the moon, but what they don't take into account is what they're paying for, right? So um, yes, you could be bullish, but if it's going to cost you 20 to 30% to be bullish on it, then that's something that you really need to take into account because, I mean, that's it's part of the risk. I mean, it's like they're not giving these things away for free. I mean, the options are going to expectations are high. People are expecting a huge move. I mean, you're going to be paying up for options, so it's something you really need to consider. And it's just kind of like it's something that you need to really factor in whenever it comes to events. What is the price to move? What's the implied volatility? What do the options look like? What do the prices look like? Is there room to still make money? And in the case of AMRN, I wasn't involved in this one. Um, not because I wasn't interested. It was just, with the way the options were priced, I just didn't have the confidence that it was going to have that type of magnitude of move. But for other people that wanted to play this, you're probably asking, how do I play an event, say like AMRN, where the options are, implied volatility is over 300%. So how do I play an event and try to still capitalize, but obviously I'm worried about overpaying for like really expensive options. So there are ways to lessen that implied volatility. So I guess that's what I'm going to talk about now. And I'm not going to get into credit selling or naked selling of options. Just it's a completely different risk profile. So something you need first of all to have margin with, and a lot of people just don't do that. So I'm not going to get into that. So strictly from a debit perspective, there are ways to lessen that high implied volatility exposure. So I mean, first off, and maybe the more basic ways to do it is with some sort of spreads, right? So if you wanted calls, so we'll just focus on the bullish position here. We'll just talk about one way. So if you wanted a bullish position and you're worried about the implied volatility, what you could do is you could just try a call spread, right? So you're basically taking a contract closer to the money and selling one further out of the money to basically lower the net debit of the trade, and that basically that'll give you upside exposure, but it'll also help kind of cut your risk overall, and you can maybe get a position closer to the money for like the same net debit. Yes, it caps your upside, but it also it gets you into a contract. So say like if you did like a 2022 call. If you did a 22 call and without a spread, I mean, it may have cost you like $3.5, $4. If you did a call spread, like a 22 to 28 call spread, maybe it would have cost you, like a dollar 50. So you can still get in to the trade with something reasonably close to the money, but you can also lower your net debit, right? Or lower that implied volatility risk. Calendar spreads, it's a little bit different, but if you wanted to, it would require the stock maybe not having a huge near-term move. So within like the time frame, like the immediate time frame, and then the more prolonged move after. So you would sell like this week's and buy the following week. So you sell this week's 22 call and buy next week's 22 call. But I mean that creates, a little bit of a different trade in the sense that you're basically betting that it won't have a big move initially and then a bigger move after the fact. Also, butterfly spreads. So these are another interesting way. You could, butterfly spreads are basically another way to kind of lower that debit, lower that risk exposure, and you're looking for a move maybe within a more fixed window. So you're thinking, okay, I think it could reasonably be between 25 and say 30 by the end of this week. Then what's interesting is you could do a fly, which would target a move, within like a window. So you could like sell you could buy the 25 call, sell two of the 30s, and buy a 35, and that would let you capitalize on a move if the stock gets above 25, but say below 30 by Friday's expiration, right? Also, another way, just if you didn't want to do any sort of complex spreads, what you could do is longer dated options, right? And yes, you're going to have to lay out more money in the sense that you're going to be paying more for time value. But as you can see, we'll use the 21 strike call, just because it's here. It's like the closer to inside market. So you can see that the implied volatility has really come down on the 21 call. I mean, these went out about $4. So you can see the trading at 70. So we'll say around 4, right? They're trading around 70 cents. They went out. They're down about 3 and 3.15 today. So around say like 3.85, right? If you were to go out to let's even go out to January. So do the January 21s. So the January 21s are traded at 308 last print, and they were down $1.80. So they went out maybe 480. So the weeklies went out at 380, right? The January options, which had another 2 months on top of that, went out at 480. So yes, you have to lay out more money because you're basically paying like an extra. You're paying for an extra 2 months, but when the stock has like a more mixed reaction, or it's down a little bit today, the near-term options have lost 75% of their value, whereas the longer-dated contract here has only lost maybe about, like 25% of its value, give or take. And you can also, what you also notice is that the implied volatility is more reasonable. So whereas the contracts run out at 300 for the weeklies here, and are still at like over 160, what you'll notice is that the January, right, 21s here, the implied volatility under 100 in the 90s. So it means you have to lay out more money because you're paying for extra time, but in a situation like this, it actually will help because you'll hang on to more premium because the time value, first off, but also because it's the implied volatility is still going to remain elevated, and these January contracts won't see like the magnitude of the premium crush as like those really, really short-term ones. So that's why it's like the short-term are attractive because you can get them for cheaper, right? But if you're worried about a potential non-event or less of an event than what the market's anticipating, then maybe pushing the bet out a month, 2 months, 3 months down the line, right, and paying a little bit more for time value could actually help in situations like what we saw with AMRN. So I hope this is helpful. I mean, it's just one of these unavoidable things with options. It's like you have to account for pricing, implied volatility. Whenever you're playing events or just trading options in general, I mean, it's always something you have to factor in. So, whenever there's an opportunity to talk about it, it's worthwhile just because it's something that it crosses your radar and it impacts your trading on a day-to-day basis. So, actually, AMRN might be presenting an interesting trade setup in the near future too. So keep your eye out for that. If the if things work out, if things work out and the stock finds a floor in like the mid to high teens, it could be a really interesting opportunity. So that might be something that's coming your way in the maybe the next couple of weeks. So keep an eye out for that. All right, guys. As always, love to hear from you. Questions, comments, reach out. Going to kick off retail earnings season in the next few days. So a lot of retailers and like some big ones too, starting with Home Depot tomorrow morning. So I'm really looking forward to some nice volatility in those guys. So have a fantastic night, and I will talk to you guys all tomorrow.